Hello everybody, today is March 7th, 2009 and I'm ZhangGe. And in this special video I will introduce to you two patterns, two very useful patterns for you, the general divergence and ZhangGe's divergence. In the previous video I have introduced to you that ZhangGe's trend level principle, and I think that if you learn it well and it will help you profit from the market. And here another two useful patterns, another two kinds of divergence, and you must have read about many divergence in the books, for example with the indicator RSI, MACD or STS, but none of the books or videos will tell you that when you should enter the market and where the stop loss is and where the target is. And here with my many years experience in the Forex market, and I conclude these two useful patterns, these two kind of divergence here, and I will explain it in detail. And first, let's talk about general divergence. And here is the rules, entry, stop loss, and target. And here is an example chart. And this is euro dollar chart and euro dollar daily chart. And here you can see that let's see the rules one by one. And rule 1 is close price of B is higher than close price of A, but Williams indicator is lower. And here I will show you the indicator I use in the MT4 Forex platform. It's a Williams indicator. You can find it in the navigator here, and you can find you can see the account and the indicator that here. And this is Williams percent range indicator, and here you can add it to your chart. And the parameter is 5 here. It's a short-term parameter, and the price OK. And here, and you can add this indicator in your chart. Because I already had one Williams indicator, I delete this one. Okay, this is my Williams indicator, and you can add it to your chart in the same way. And let's come back to my document. And here is the Williams indicator, and here and the close price is higher, but the indicator is lower, and just the same as general. And the second rule is that the close price of F and A and B are bull candles, and F is a bear candle, and the close price of F is lower than close price than the 5 days SMA, simple moving average SMA, and the corresponding Williams indicator is lower, and the corresponding indicator of F here is lower than the neckline, the indicator. Okay, use there will be some candlesticks between A and B, and then we can draw the neckline. Use the open price or the price or the close price of these necklines. And this is the example. Use this candlesticks close price, and we draw the neckline here. So, and the close price of F is lower than the 5 days SMA here. The white line is 5 days SMA, and the corresponding indicator is lower here. And just as I talk about here are the rules. And if all the rules are satisfied, and when the price here, and the next in the next candle, when the price here is cross the low price of F here, cross the low price of F, we can enter the market, build our bear position, and put our stop loss as the high price of F, stop loss as the high price of F. And our target, we have two targets, and whichever is reached, we close our position. And here, the open or close price of A, the open or close price of A, and the open close price of A is here, and it's already reached here. And we can wait for the second target. It's the same space from neckline to the this is the space from the neckline to the height. From neckline to the height, we use open or close price. We don't use the low or the high price. We just use the open and the close price. And here we use two close price here to describe the space between the neckline and the height. And this is our target. And you can see that a few days later it reached our target. And this is the chart just a few days ago. And let's take a look at. And you can see that the data is February 25th, 2009, and the Euro daily chart just a few days ago. And this is general divergence A, B, and F, and we enter the market here, build a bear position here, and our target is this line. The same space between the neckline and the height, and here. Okay, that's all for the general divergence. Let's take a look at the second kind of divergence here. Well, I named it ZhangGe's divergence. Well, and here, and also A, B, and F. The rule 1 is here. The height space of B. The height space of B is lower than the close price of A. It's different from general divergence here. The rule is the close price is higher than close price, but we just demand that the high price of B is higher than the close price of A, and the Williams indicator is lower. You can see that here. And the close price of F is lower than 5 days SMA, or lower than the neckline, a little different from the from the general divergence here. And here, and also the corresponding Williams indicator here is lower than the neckline, just as I explained before. And also the entry is that the next candlestick, when it crosses the low price of F here, in the next day we can build a bear position here, and our target is the same. And the open or close price of A is already reached our second target, the same space from neckline and the height. And with the history chart, you can test, you can find and test these two kinds of divergence here. I've already tested them, and a relative high success, a relative high percent of success, about more than 70%, more than 70%. And if you have spent some time to understand it, and to especially, and you find the history chart to test it, and I believe you will benefit a lot from it. And that's all for today's video. So thank you. Well, here's my email and my MSN. Both are fx.analyse@hotmail.com. And if you have any questions or any bright ideas, please contact me. Furthermore, we will make about 200 Forex tutorial videos, and the first half is totally free for you. Furthermore, we provide real-time trade advice to help you profit from the Forex market, and if you need it, you can let me know. So that's all for today. Good luck and goodbye.